Hey everyone. So this panel is about new investment tools and products in the space. So on stage with me, I have some guys behind some of the top companies in the space. So to start out, I thought we'd just go over a brief introduction to yourself and the platform you work for and sort of the tools that you provide to end users. To start myself, I'm currently a founding partner of a hedge fund called Tetros Capital. Prior to this, I was a research analyst at CoinDesk, and before that, I was a founder of a mobile app called lawnmower.io, which was all about making it easier for retail investors to invest in and research cryptocurrencies. So Hugh, go ahead and start.
Good morning, everybody. My name is Julian. 3 months ago, I was Senior Vice President at State Street Bank, and now founder of a new company called OmniX. We're basically building the first large-scale investment and trading platform for crypto. Prior to that, I was very early on in a company called CurrentX. So we built the first large-scale institutional currency exchange. Ended up being the biggest high-frequency currency platform out there that was acquired by State Street in 2007. So I've been in State Street for the last 10 years, and off we are now in a startup.
Cool. I'm Dan Matuszewski. I run trading at Circle Internet Financial. We primarily run an OTC liquidity provisioning desk, so people will come to us to source large blocks of liquidity in a whole plethora of digital assets, mostly Bitcoin and Ethereum. Prior to crypto taking over my life, I was an equity derivatives trader for a hedge fund a little south of Boston.
Good morning. My name is Michael Sonnenschein. I'm head of sales and business development for Grayscale Investments. We are a digital currency-focused asset management business and a wholly owned subsidiary of Digital Currency Group. Today we have 3 products in the market, the Bitcoin Investment Trust, Ethereum Classic Investment Trust, and Zcash Investment Trust. And we manage about $1.8 billion across the 3 products.
Morning, everyone. My name is Adam White. I'm the general manager of GDAX. GDAX is the institutional exchange operated by Coinbase. Coinbase is our retail brokerage. It has about 12 million retail customers, and GDAX is really designed for that kind of sophisticated and professional trader. We're one of the largest exchanges in the world, the most liquid here in the US, and provide basically a high-performance central limit order book for our customers to trade on.
Great. So why don't we start going back the other way, starting with you, Adam. What I'm curious now is, in the last few years, obviously the industry has come a long way. It seems you guys have all been involved for a while. Maybe 3-4 years ago, the narrative really was only Bitcoin. But maybe you could talk about how your product or platform has evolved over time and kind of why was GDAX even around at the start of Coinbase?
So I was an early employee of Coinbase. I was number 5. And back then, all we had was Coinbase.com, which was really designed for the kind of new novice investor to get a little bit of exposure to Bitcoin at that time. And we very frankly thought of ourselves as a Bitcoin company. And what we saw happen over the coming years is emergence of new digital assets. I think Ethereum really kind of led the way. And we've seen that continue to grow this year, especially with ICOs and new tokens. From that, we recognize that in order to provide a really good, simple buying and selling experience for our retail customers, we needed a source of liquidity. And what we did is we set out to build GDAX back in 2015 as that premier institutional grade regulatory compliant exchange. So we set out and did that, and frankly, it was an experiment at the time. And what we saw is it grew from kind of a small exchange into a pretty meaningful, significant component of our business now. About 1.5 years ago, we spun that out as a separate business. So it's still under the Coinbase parent brand, but it operates very much like you would like any other separate business. Right now, it offers kind of basic order types, so limit orders, market orders, stop orders. We're working to add new assets. That's very frankly what we hear most of our customers want. And just a few weeks ago, we put out something called our Digital Asset Framework. And this Digital Asset Framework is effectively our take of listing requirements. It is what you might see for the New York Stock Exchange or NASDAQ. It's a qualitative and quantitative kind of methodology that we use to look to decide when are we going to add a new asset and in what order.
Before we move on, I guess, Adam, is there any way you could summarize sort of what the framework says? I understand it's pretty exhaustive and everyone should take a look, but any way you could sort of give an overview of, what can we look forward to? What types of assets would maybe make the cut? What definitely won't?
Yeah, so it's a really complex question, and how we broke the framework down was into 6 different sections. A couple of them were, well, what's the legal regulatory structure of this asset? So we need to make sure if it's likely to be a security, that's not something we can currently add to GDAX because we're not regulated as a securities exchange. We also look at demand side dynamics, supply side dynamics. We look at governance. So we look at kind of a holistic A to Z type perspective to decide not only do our customers want this asset, but is it safe? Does it kind of provide real tangible benefit? And does it really align with our mission at Coinbase to help create an open financial system for the world? That's really, at the end of the day, what we're trying to design our company to do. And a source of liquidity is an important piece of that we're trying to serve.
Awesome. So, Michael, I guess some background. When did Grayscale get started? When did GBTC come out? What actually is GBTC? It's not an ETF, but a more custom product. And why and how did these other products come into existence?
Yeah, absolutely. So Grayscale came into existence in September of 2013, which is when we launched the Bitcoin Investment Trust. As a mission, I think that Grayscale as a firm wants to make the digital currency asset class familiar and accessible for both retail investors and institutional investors. And so when we look at other access products, whether it's the Spider Gold ETF, and that allows people to gain exposure to gold through their investment portfolios, we want to try and mimic that same accessibility and level of familiarity. And so we launched the Bitcoin Investment Trust originally as a private placement, only selling shares to accredited investors going back to 2013. In 2015, we transitioned the fund into the public markets, and so it is quoted on the OTCQX market here in the US under the symbol GBTC. And so that acts as a liquidity mechanism for any investors that invested in the private placement directly. And we had historically been pretty conservative about the types of vehicles that we wanted to launch. We got very excited about Ethereum Classic about a year ago, have also gotten very excited about Zcash and have consequently launched funds for both of those products. And recently announced that our Ethereum Classic product too will make its way into the public markets, hopefully in the second half of 2018. And for us, I think as the investor landscape continues to grow and there's demand now beyond just Bitcoin and beyond Ethereum, we'll continue to roll out a whole family of products to keep making the asset class accessible to investors.
Interesting. So how has the AUM grown and who are the normal investors into some of these products?
Sure. So our AUM is up almost 1,000% year to date. We manage now just shy of $1.8 billion. I'd say that our typical investor historically has been family offices, high net worth individuals, and probably starting about 18, 20 months ago is when we really started to see institutional demand. This started coming from hedge funds, both domestically and abroad. They had various mandates. They could be value investors, they could be global macro investors, they could be tech-focused funds. But really, no matter what the strategy was, we started to find that the ability to get exposure to digital currency through the purchase of a security was something that the accountants, the auditors, the lawyers, the chief compliance officer, it was all something that they could get their heads around. And so that's been a really large driver of our asset growth.
Okay, I guess just to summarize, are you saying it being a security and following more traditional accounting practices and such are the main reason that these clients are buying GBTC or the Bitcoin Investment Trust versus the actual token itself? Or why, I guess, are some of these people buying into the trust versus the actual raw asset?
Sure, so I think that there are some fantastic products for people to gain exposure to digital currencies like Bitcoin directly, like GDAX, like Coinbase. There are still limitations and an educational curve that I think a lot of investors need to overcome. They're typically used to going into their Schwab account or their Fidelity account or calling their financial advisor to buy a given stock or a bond. And many investors also want to put tax advantage money to work into digital assets. And so by purchasing a security like GBTC, investors can actually put an IRA into that product or a 401k or any other kind of tax advantaged account as well.
Gotcha. So Dan, Circle's an interesting story. I mean, the first iteration was a consumer-facing mobile app for buying and selling Bitcoin. Now it's changed into a whole bunch of stuff, including an OTC desk. When did that product get started? Was it just Bitcoin alone at the start? Have the minimums increased, the range of assets you trade? What's Circle's evolution look like?
Yeah, so you're right. In the beginning, my role primarily was for sourcing customer liquidity, which was, we offered a Coinbase type model where you could buy or sell small amounts of Bitcoin and all that risk would build up. We would sort of like hedge it out across the day. We'd do it on exchanges, we would do it on OTC. And when we first started this, like GDEX wasn't even around. There wasn't a ton of liquidity providers out there that were like very easy domestic to face. We ended up doing a lot OTC through Genesis, through Cumberland, like the existing players. And what we found pretty quickly was that there was a pretty big niche here to be filled for the OTC liquidity provisioning side, in the sense that if you're, now it's a little bit easier, but back 2 years ago, if you were looking to buy $1, $5, $10 million worth of Bitcoin, and this was all Bitcoin in the beginning, this was really like the only thing that had enough liquidity that we were like, thought that we could play a market here. It was hard. You had to wire money to multiple sources. Like the pricing was very hard to like figure out because it was moving away so much. A lot of it was trading off screens, you wouldn't even see it. And as we became bigger and bigger in the Circle product and we were sourcing larger and larger amount of liquidity, we started to actually build up a pretty good amount of knowledge on how like stuff moved around in this, and we actually became a part of that ecosystem. And the OTC liquidity flow that we were really sourcing at that point started to dwarf what the retail offering was on the app. And at that point, we just decided to like build that part out, and we got better with the exchanges. And today, it's a very, very different world, and it's like it's weird to see that like large amounts of Bitcoin trade pretty tight, like in the OTC markets. It's actually like this evolved into a real like asset class that people are allowed to like move in and out of liquid. And watching that whole progression go through, we also noticed that people really wanted to move out the risk curve, and they really wanted to start speculating on some of the other digital assets. ETH was the clear big one that like really grew, and we were like able to take a stake in. But something like Bitcoin Cash, for instance, like that basically got liquid and tradable instantly, which was shocking to us, right? Like this thing was born out of nowhere, so to speak. Like, I mean, there were plans and whatnot, but like it was moving size in the OTC markets, and people were like interested in doing this thing, and it became one of like our bigger products we traded. So I think going forward, I'm not sure that like the product suite that we have of like things that we trade, like there's probably 5 or 6 that are like really liquid that we're like doing OTC with people, but that's definitely going to balloon. Like there's going to be more, there's going to be other things that people want to trade. There's like going to be need for liquidity on some of this stuff. And we've been able to really help guys that want to get liquidity in some of those other currency, commodity, whatever you want to call it, asset classes, because those tend to be a lot harder to source out of the gate because there's regulatory concerns on like listing new things. Like, I mean, GDEX has a framework, stuff doesn't come out immediately, but until they get to those exchanges, there's still markets for them that people want to like get into, and people are going to want to be in these positions, especially as we're now seeing a whole bunch of funds that are opening up. People are taking different bets. People want to like get liquidity in this stuff. So that's really how I see this evolving. Is like it's going to be a pretty large asset suite of products that are sourcing liquidity that we're out there for.
Interesting. So generally for you guys to help trade in an asset, there needs to be some sort of liquid market, and it needs to meet your sort of regulatory criteria. What other things are needed for you to start trading in these other assets?
Yeah, the big thing is the biggest thing is that due to the SEC's comments most recently, like everything has to be approved by internal legal to make sure it's not a security, because we aren't a broker dealer. We're not able to trade those assets if they are classified as securities. So that's the first internal look that we'll take at it. But that's pretty easy for them at this point to diagnose what is and isn't tradable from that side. And the second thing is it's got to have at least 1 or 2 exchanges with deposit withdrawal capability and some liquidity on it. And like once that's good to go and the blockchain, if it is blockchain based, is like solid and there's no security issues, like it's game on.
With deposit and withdrawals, do you mean with fiat pairs, or is crypto fine?
The crypto, so we have to be able to get in and out. We have to be able to move it beyond just like our own. Like we need to know that the market that we're looking at is real in the sense that like asset can come in and out and like trade, right? Like so Bitcoin Gold is a great example, and a lot of exchanges were trading it, but it wasn't open for deposit withdrawal. So that price really isn't worth a lot, right? Like, because unless you had it there at that time, it's like this weird closed-end thing that happens. And you see this, that the prices diverge wildly on those assets until they're like actually able to freely move about. So that's a big criteria for whether or not we'll like let something open up for trading.
Gotcha. Okay, Hugh, so OmniX has an interesting history. It's been a long journey since you got here. Maybe you could talk about how the product has evolved and why you're building the features you're building right now for the market. Why is there a big need for what you're creating?
Yeah, so look, the OmniX, the company itself, is very new. So we've only been around 3 months, and this week we just announced our institutional round of financing. It's not an ICO fund. It's traditional institutional venture financing. So the company is very new. I've been in State Street for a long time, but I've actually been in the institutional trading space since early 2000s. I'm pretty much the oldest guy on this panel. I look young because I'm Asian. So what we originally did in early 2000 was, it's a Silicon Valley-based company. In early 2000, we looked at currencies. And currencies was traded at that time not as its own asset class, but as a byproduct of corporate treasury requirements and other real money funds. And people were picking up the telephones and going to the desk, going to the Goldman, going to the Morgan Stanleys and all these guys and saying, hey, give me the best price. We said, look, why would we do that? Why don't we put this thing on the internet, this thing called the internet? And ended up happening that way. And what really made that happen was because of the credit industry, right? The prime brokers and the equity space moved into FXPB, and we became the largest currency trading platform for high-frequency traders. So coming into the State Street world, kept running these kind of businesses. For the last 2.5 years within State Street, I ran a lab called the Emerging Technology Center. So we looked at everything from AI to blockchain, all of this interesting stuff. And one of the questions that we kept getting asked by clients of State Street, and these are multi-billion-dollar and trillion-dollar asset managers, and the question in the last year basically started moving towards, what is crypto asset? How do I get access to crypto asset? How would I trade crypto asset? How do I custody crypto asset? So in a lot of ways, even though this market is very, very small compared to other asset classes, we're in the same market dynamics, right? We have not that much infrastructure. And part of the reason for that, I think, is because most financial, pretty much more than most, all financial products started from the institutional space. And when the technology got stable enough, the price got cheap enough, it got pushed down to the retail side. This is one asset class where it started from the retail side and is now moving upward into the institutional side, and there is no infrastructure. If you ask most of the funds, you guys here, how do you trade? You use a spreadsheet, right? You go onto 3, 4, 5 different screens to trade. This is not the case for institutional folks, right? You need the infrastructure to make this happen. So we are not an exchange. We're not trying to be a GDAX. We're not trying to be an OTC desk. We're not trying to be a custodian. We're trying to be that market infrastructure that ties all of these fragmented markets into a single venue. If you need a portfolio management system, if you need an order management system, if you want to trade directly with your counterparties on the exchanges, you can use our direct market access. But if you want to get best execution, satisfy your fund managers for execution requirements, you can use our algos and do it programmatically. So basically what we're trying to build is like that institutional infrastructure that exists for every other asset class, but don't yet exist for crypto, and move crypto into a true institutional asset class.
Okay, so let's build off this theme of crypto sort of starting with retail and moving towards more institutional buyers. Adam, I think this would be an interesting question for you. How has Coinbase's and GDAX's general user base of buyers changed over time? Seemingly there's more institutions involved now. That's kind of why GDAX was launched. Now you have this whole new institutional custody product. Maybe you could just talk about in general how you're seeing the usage of the customers of GDAX change, and who kind of, I guess, is your target customer for the specific segments of your business now?
Yeah, so largely by user count, most customers tend to be retail, right? Day traders, semi-professionals, they do it as a hobby. What we see by trading volume is the vast majority of that volume comes from the institutions. So what we've seen is this wave of institutional adoption that started at the end of 2016 and has continued throughout 2017. And what's been really interesting is I think there's been a couple catalysts that have actually charged that. One is we've seen a professionalization or a maturation of the space and the technology. So this idea that every time Bitcoin dies and doesn't go away, I think people take a bit more notice and go, let me actually try to understand this and not necessarily write it off. So we've seen that just happens with time. The other thing we've seen is the interest in crypto derivatives and CME's announcement, SIBO's announcement, and others. I think that is driving a new wave of institutional trader to the space. Many of the traditional derivative market makers are now saying, in order for me to hedge my risk, I need to be able to trade on the spot market. And they're actually coming to exchanges like GDAX now to really understand the infrastructure and understand the regulatory structure and everything that comes along with that. The third thing I think that's happened is that we've just seen the infrastructure, the tech improve over time. So for context, GDAX's average daily trading volume has increased 10x since the beginning of this year. It's increased probably 30x from 2 years ago. And that's really put a strain on, I think, our matching engine, our systems, and there's been a number of other exchanges in the space that have also felt those growing pains. I think what's been really interesting, though, is you've seen a number of exchanges really double down to say, in order for us to attract this institutional caliber trader, the exchange has to be performant, it has to be up. This is a market that trades 24/7, 365. The idea of going down for a couple hours a night for software upgrades is just kind of antithetical to the space. So what we've seen is this retail-driven adoption early on, but now far being outshadowed by the institutions that are coming to trade in the space. And I think it's frankly really exciting.
Interesting. So maybe we'll skip Michael since we heard a bit about the general investors into some of your products. Dan, I'm very interested to see how your sort of trader base has evolved over time. Seemingly the initial traders were maybe large early Bitcoin whales. Now you have a slew of institutions. Can you talk to the volume and the type of people trading with you now?
Yeah, definitely. So there is a core group of people that we trade with that have sort of always existed in the ecosystem. A lot of these are players that you know that collect fees technically for whatever product it is at any given time that are in crypto. So they have a natural need to work into the market constantly. So that business has sort of always been the same. Those guys are just suddenly making a lot more money because it's basically the same amount of crypto that they're collecting. There's that side of the house, and there's the miners and others that basically have the same needs of constant crypto. So that's always been the same. That's really always been the same amount of Bitcoin that's moving. The dollar amount has just changed. The buy side ticket volume has exploded, really, is what we've noticed. You would get an order for $1 million of Bitcoin 2 or 3 years ago, and that was huge. That was an order that you would see once every month, and you'd be like, "Well, this is awesome. We can do this." And now our average ticket size is almost that big, right? And we have people that are looking to do 10, 20 in a single slug. So that has really changed. The sort of large ticket institutional size liquidity needs on the offer has really gotten big. I would say most of the actual liquidation sites of the sellers of crypto have basically stayed the same. The only thing that's a little bit different is you have these really chunky ICO events now where there's real burst needs of liquidity from certain participants in the market. That's a new nuance to it, but it's not that much different than things of the past on the ones that are sort of looking to liquidate. There's people that get crypto that just don't want it. They don't want to take that risk, so they look to get out and they look to eject. But it's really the buy side that's just completely caught us off guard. And it's good. I mean, you clearly see this in the market, right? The price is going through. They're sourcing that liquidity, and you can actually get it done now, which is the other amazing part.
I guess to get a sense of the magnitude, do you have any statistics you can share on unique number of counterparties and how those have grown over the years?
So the thing about unique counterparties is there's a lot of people that are one and done, right? They onboard, they come in and go. So that number by definition always just has to go up too, right? There's can only be more. I'll say we're onboarding at about 5x pace we were a year ago. And that I think largely is also we've been a little more public about what we're doing in that business, and I think more people have come to us. So that's feeding into it as well. But there's definitely more people reaching out that are new buy-side clients almost exclusively.
I guess to dive into a little more, we keep talking about institutional buyers. What is the composition of these institutional buyers? Is it mostly new crypto funds, existing hedge funds, family offices? Who are these big institutional buyers?
Yeah, so the crypto funds are obviously part of that spectrum, right? They're the easy one in the ecosystem. That makes a ton of sense. But in terms of appetite in the institutional side, it's really family offices and small funds right now that are able to be that nimble. And I mean funds in the sense hedge funds. There's not a lot yet at the bulge bracket investment banks that are looking to pull the trigger yet. We're having conversations with almost all of these guys at this point, but they're just not able to move as fast. And I think it's mostly an internal risk appetite that's gating that down. So it's really the smaller, nimbler funds at this point. A lot of family offices, they can obviously move very quickly.
Awesome.
Alex, I would add on to that I think that the narrative around this has changed dramatically, maybe even over the last 12 to 18 months. I think 18 months ago, a typical hedge fund, a global macro fund, whatever it may be, would never even dream of writing about Bitcoin or digital currencies in their quarterly, LP letter. And now their LPs are calling them up and saying, why don't you have exposure to this asset class? And so whereas it maybe used to be the managing directors of these firms that were personally dabbling in the space, now they kind of feel like they have no choice but to start looking at the space, getting smarter on it, and starting to make small allocations. And so what we're kind of experiencing is seeing allocations anywhere from as little as 50 basis points to 300-400 basis points. And in those types of scenarios, they're almost looking at an investment in digital currency as a call option, right? If this goes to zero, which a lot of people are having a hard time identifying why that might be the case, it's not going to be a material drag on any of these single funds performances. But if it continues to have the kind of outsized returns that it has been experiencing, and we all think we're still pretty early in the life cycle of where these assets can develop to, well, then it becomes this really meaningful driver of performance. And so I think approaching digital currencies, including digital currencies as part of a diversified portfolio is something that a lot of portfolio managers are really starting to catch on to, and also starting to look at, validation, having CME Group launching futures, and having the rhetoric around digital gold or a digital store of value starting to really resonate with them as well.
So let me, I just want to add something to that as well. This is definitely a moving target right now, right? We're in this event that we're calling the institutional side of crypto. But let's look at this, right? 3 months ago when I left State Street, it was at 150 billion in value. Right now, we're just cracking 300 billion. This is nothing in terms of the size of a true institutional market, right? If you're someone like a BlackRock, let's not even worry about it. Let's look at someone at just $100 billion fund, and you take 1% of your alternative portfolio, you get 10 of these funds, they're going to suck up the entire market, right? So big reason why I think the institutional guys are not really in it. It's just because this market size isn't quite big enough just yet. Now, are we at a point that we're not going to fall back to zero? I think we're pretty much past that, right? But we haven't reached escape velocity yet to truly take this into institutional level. We got to get up to the $1 trillion range when people can really put meaningful amount of assets into it. And then the next question is, why aren't they putting that asset into it? Obviously, there's reputational risk. There's a lot of other risks, right? But big part of that is, there is no infrastructure for this kind of stuff right now. What if you want to take things that are in the hundreds of millions of dollar range, right? There is no system to do this. There is no algorithmic execution. There is no best execution. You look at the funds today, and many of you are the fund managers here, right? You're taking on this asset just because it's going to grow 20, 30, 40% in the future. A year or two comes around, and your investors come to you and say, what was my cost of execution? There's no real way right now for you to give them that. Right? Are you really doing best execution for your client? So I think the whole market needs to mature more, and it's happening on a day-to-day basis, right? The asset is growing, the different market makers are coming up, the institutional guys are coming up, and players like us trying to build that infrastructure. So as much as we want this to truly be an institutional asset class, it's not quite there just yet.
Okay, interesting. So it seems like the narrative for years and years was there's all these barriers from institutions to get in, stuff like custody or these trade execution engines or the overall regulatory environment. But now it seems that the first institutions are starting to jump in and some are still on the sideline. I guess anyone can take this question, but what's really changed in the last year that's caused people to start jumping in? Is it just FOMO from LPs that have sort of forced the most risky people to jump in first? What barriers still exist? I'm just not really sure what has been solved infrastructure-wise that's led to this, 10x appreciation in Bitcoin over the last year.
I'll start out.
Go for it.
I'll start out a little bit. Look, I think let's just all be honest with ourselves, right? Decentralized application will work in the long run. But the reason that everybody's jumping in now is because you're getting 10, 20, 200x returns every year, right? And that FOMO is what's fueling everything. But at the same time, I think we've all lived through many cycles of technology disruption, right? You ask all the VCs in the Valley, you ask VCs everywhere else, they understand that this is a bubble. But so was the internet. People knew that the internet was going to be a bubble, but people knew that companies were going to come out of the bubble that really changed the world, right? So there's this short-term chasing of missing return, that's FOMO, but there's this long-term view that this is a transformational technology. We don't want to miss out. And I think, why are people getting into it? It is because the market is being more and more mature, right? You no longer have exchanges that fall over all the time. You have more and more institutional players jumping in. State Street at one point, my previous company was actually the fund administrator of the Vinkovas ETF that was there. And it was almost unthinkable 2 years ago for a bank like that to participate in that world. And it's happening. And I think it's almost everything. I don't know if there's one particular thing you can pinpoint, but the market is maturing.
Interesting. Anyone else have anything to add? Or I guess if I could slightly change it, what huge barriers do you think still exist? Are they the same and yet people continue to drive in because FOMO's there and people are willing to take risk? Or what barriers have come down recently and what still exist as major things keeping institutions out?
I'll take a first crack at that. I think one of the biggest issues, at least for clients that we see, is around custody. A lot of funds, a lot of institutional investors, by mandate, can't self-custody. And until traditional custodians start custodying digital assets, they don't have all that many options available to them. And so I think projects like Hugh, I think projects like a lot of other folks here today are working on that are developing both really institutional grade custodial solutions, pricing mechanisms so that we no longer have this global, disparate order book that is operating 24 hours a day and at the moment creating a lot of arbitrage and interesting opportunities for investors. I think until we see a more balanced global order book and have the actual underpinnings and the actual pipes running that can allow people to buy and sell and trade and settle their trades in an easy fashion like they would other assets that they typically traffic in, it's going to continue this way. But I think we're evolving very, very quickly. And as those barriers get lowered and as those platforms become available, you'll certainly see more and more entrants coming into the space.
Yeah, I mean, just to piggyback on that, custody is still the single biggest issue for the majority of people we deal with. And it's a reoccurring issue for us basically daily because we get a lot of people that come to us who are like very, very interested in like sourcing a large block of liquidity for whatever digital currency they're like having to be looking at. And almost universally, the issue that comes up is that we can't hold this for you, right? This has to go out the door. I have to send this to somewhere for you. And this is a foreign concept to a lot of people that are just, they don't know a ton about crypto, but they know obviously like investing and like they never think about like, oh, like where's my stock held? Like how does this whole process work? It's just not a thing that they ever really thought they were gonna have to think about. So that's like a big issue. And I mean, outside of, there's okay solutions for Bitcoin custody now, right? Like there's providers and there's like solutions, but like you start going down the stack, like after ETH, like there's nothing for any of the other assets that are out there. Like you can't park that stuff anywhere. And like some people even choose to park it on exchange, which is dangerous. Like you shouldn't really be doing that if you can avoid it. And I think this is just an interesting market data point that you can use like to show how, so GDEX tends to trade at a pretty good premium to the other exchanges on the dollar cross. And a lot of that has to do with the fact that people are willing to take exposure to GDEX, but they're not willing to take exposure to the other market players in the ecosystem, right? Like people don't want to wire to some of the other exchanges. They don't want to deal with non-US things. Until that whole problem gets solved, like I think you're going to have some people like waiting to step back, because if you have this disparate pricing around, it's showing that there's still a lot of mistrust that's like sitting throughout the ecosystem to a lot of players, and that's just part of the world. And like there's been bad things that have happened to exchanges in the past and like have caused the reason for the pricing to be different. But that's another gating factor, I think, until larger institutions can still get comfortable with this.
Awesome. So obviously Coinbase is one of the largest places for new users to get into Bitcoin and other digital currencies now. Adam, I guess, could you speak to how users generally custody their funds on Coinbase? Do people use the vault product? Do institutions keep balances on the exchange? Was it users asking for the new institutional custody product that drove that?
Yeah, so a few weeks ago we announced Coinbase Custody, which is a new product offering coming out of Coinbase, and it's effectively designed to serve as a qualified custodian for institutions. And the idea there is that we already store more than $10 billion worth of digital assets on behalf of our customers. And that's because the vast majority of our customers are looking for a one-stop solution. They want to create an account, they want to buy some digital currency, they want to park it there safely, and then kind of forget about it, right? They're using it as an investment, not as an asset they want to purchase to then go use the network. That does happen, but it's definitely a minority. What we set out to do by creating Coinbase Custody was create a product that can not only serve institutions in a legal and regulatorily compliant way, it's more than just having great tech from what institutions need, right? They actually want you to check that qualified custodian box. They want to know who your regulator is, who your auditor is, and what's happening behind the scenes. So that was our intention with Coinbase Custody. That Coinbase Custody product is going to serve both GDAX and Coinbase, which are in effect similar to a retail brokerage and a prime brokerage in many sense. So that product is there kind of as the back-end supporting infrastructure for the space, and we hope to set out and support not just our own products, but others as well.
Awesome. So I guess I'd like to talk about some missing investment tools we haven't really discussed are actual ETFs and the derivatives market. It seems like the SEC cited the lack of a derivatives market in their rejection of ETFs earlier this year. If any of you guys could speak to sort of why do you think an ETF has been held back? Do you think a derivatives market will be established first, or any sort of experience you guys have had looking into products like this? I'm sure many of you have. Maybe Michael, you could go first.
Sure. Yeah, so my team spent the better part of 2017 working with the SEC on uplisting the Bitcoin Investment Trust from the over-the-counter market here in the US to a New York Stock Exchange listed ETF. And through conversations with them, we ultimately decided to withdraw from that process earlier this year, given that there are a couple of roadblocks that the SEC, I think, still is looking at in terms of approving that type of a product. I think, Alex, you hit the nail right on the head. I think one of those is certainly derivatives that they'd like to see. The legislation around ETFs, ETPs, et cetera, isn't necessarily the right framework for an asset class like digital currencies. And so I think what we're now experiencing is a time where the SEC is getting smarter on the asset class. We're certainly doing our part to help educate them and work collaboratively with them. But I think they agree, as does the investment community, that this as an asset class has arrived, it's here to stay. And we are very much proponents of giving investors the protections that an SEC reporting product can offer as people are looking to gain exposure to the space. So I don't think an ETF is a matter of if, it's more just a matter of when.
So do you think a derivatives market will need to be established before an ETF is approved? And also, I guess, another cited concern of the SEC was, I believe, concentration of trading volume in China at the time, which is distributed globally after the PDOC broke down. I guess, what is holding the two of them back? And will it be in that order, most likely, in your opinion? Being derivatives first and then an ETF?
Yeah, so I think on the derivatives front, I've been working also helping the CME on the development of their futures product, and very excited to see it launch. I think in pursuing the ETF and having conversations with all of the bulge bracket banks and their trading desks, one of the big questions was always like, we're happy to be creating and redeeming shares of an ETF when it comes, but how do we hedge our exposure? And there was no way for them to have a bona fide hedge, and the creation of a futures contract like the CME is gearing up to launch will certainly open the door to that. How quickly the futures market develops, or how deep or how liquid it is, obviously remains to be seen, and I think that's one of the things that the SEC will be looking at quite closely. But it's hard to quantify what will be significant markets in the derivative space.
I'll add a little to that as well. I mean, this market infrastructure, we keep coming back to that. It's a huge piece, right? When ETFs go and become available, anybody can go buy it, right? We can just, your brothers, your sisters, your kids, anybody with a brokerage account can just go buy it. And an ETF is not a simple product, right? It's a structured product. And there's a primary market that we purchase, and there's a secondary market. Well, sorry, we actually purchase ETFs on the secondary market. There's a primary market, the broker-dealer space, that actually keep the prices in sync. None of that stuff is available today, right? And the derivative is huge. Any market, you need a derivative market to hedge your risk. And it's not just forward contracts and options contracts. There's a bunch of other products. So things like, ETF gold is a great example, right? There's no reason why you can't have an ETF for Bitcoin, because it's just like gold. You can have a digital gold version of that. But we simply don't have the infrastructure to make it possible. We don't have the market to make it safe yet. And also, it's very prone to manipulation right now if you look at sort of the way we do valuation and pricing. We talked about that a little bit as well. Until we start having real global standards for indices and pricing and all these different markets, I think it's just going to be very difficult for the SEC to approve that for the general public.
Gotcha. So let's talk a bit about margin trading, or trading with debt. Is that popular on a lot of your guys' platforms? What are your general thoughts? Adam, I guess we'll start with you. Do a lot of people margin trade on GDAX? I believe that ability was even suspended at one point, or how did this get added, and where's it at now?
So there's a strong demand for leverage in the space, absolutely. And if you look at the kind of global cryptocurrency exchange space, many of those exchanges offer margin trading or leverage trading. That's something that we at Coinbase recognize, and ultimately we want to build the products that our customers want, so that's something that we set out to do. We've since put pause on it as we're making some improvements to it, but hope to relaunch it soon. I think that idea for kind of a prime broker is pulling up a level what's really in demand right now. These large institutions want to operate in the space that they're familiar with the same regulators that they know, with the same language that they're used to. And I think that what a lot of exchanges have done early on is offer this kind of retail version of margin trading. It's our intention to make it at a level that meets institutional requirements, and that looks like things like an institutional lending market as well, most likely. So these are all kind of components that we want to build into our product that ultimately is going to appeal to institutions, and I think margin's one piece of it, but not the only piece.
If anyone else has anything to add, feel free, or else I'll wrap up with some final questions here.
I just guess on the margin trading side, I think there is a real strong need for the ability to get borrow and to have like an actual clearing on that. It's like, and not just even to go short, just to have working capital facilities for some of these desks to be able to actually like make markets in spot, and then ultimately the futures. Like they're going to need to be able to borrow Bitcoin at times. So I would like to see that in the world in sometime soon.
Gotcha. All right, to wrap up, we have about 3 minutes left, so I'd like to just go down the line. General investment tools and products that we can look forward to either from your platform, if there's no upcoming announcements, the industry as a whole. If you don't really have something there, since this is an investment conference, let's go with some price predictions over maybe the next 6 months, since we all know longer than that is an eternity. Hugh, go ahead.
I'll start. First of all, we've been around for 3 months. We just got our investments. We're basically building this end-to-end platform with portfolio management, order management, execution, and back office facilitation components. So we're looking to launch end of Q1 in 2018. In terms of pricing, I mean, I'll just tell you what my investor deck looked like to our investors, right? Our prediction is that by the year 2025, we get up to about 50,000 in the Bitcoin pricing, which is a combination of looking at what current market analyst predictions are and just taking those numbers and pairing it with traditional asset classes of currencies and other asset classes. So, but recently, I can't remember the gentleman who retweeted his 2014 tweet, right, on the logarithmic curve, where we basically hit 10,000 right about now, and we're pretty darn close. If his curve is still correct, by the year 2025, I think we're about, 300,000 or something? So I'm not going to go that territory, but I think 50,000 by the year 2025 is very reasonable. Okay.
I think we heard Mike Novogratz say it would hit 40 grand by next year, and I think you were talking about Tim Draper, who called 10 grand in 2017 by 2014. But Dan, go ahead with whatever Circle has to offer or your general predictions.
Yeah, so I can't say anything specific, but we've got some big news that we're going to be dropping pretty soon, so just stay tuned on that side. And on the pricing, I just say the trend's your friend on this thing, so stick with that.
Fair enough. Go ahead, Michael.
So on the Grayscale team, we're going to be launching a series of other products over the next, call it 3 to 4 months. That'll take the form of a couple of more single currency vehicles that investors are asking us for, want exposure to. And I'm also very excited and very pleased to announce that we'll be launching a basket fund, hopefully within the next 90 days, which will give people exposure to the top 5 crypto assets by market cap, and we'll get quarterly rebalanced. And so as we are interacting with our investors, we're constantly asking for ideas and want to know what they want to invest in, and we'll continue to create products that give them that access.
Awesome. Even more assets than the existing 3. That's great. And Adam, go ahead and wrap us up.
So from the product side, I'll go a level deeper on the custodianship product. We spent a lot of time talking about speculation, investment, what's the price going to be. I think we need to spend more time thinking about the utility. Ultimately, how is this technology going to solve problems and provide real value to everyday users? One of the unique things that some of the digital assets are moving towards is this idea of proof of stake, which effectively generates a return by holding on to your assets. So as we think about custodianship products, we're looking at providing that new revenue back to our customers. So it's akin to kind of an interest-bearing account, but it happens through a much different mechanism. So that's something that I think you'll find a core component of the custodianship product. As for the price as an exchange operator, I really stay away from that. So sorry, Alex. Focus more on kind of fair and efficient markets. I will say that the thing I like to pay attention to is volume and liquidity and order book depth. I think if you fast forward 6 months to a year, we'll look at daily trading volumes now, and they'll be an order of magnitude 10x higher.
Awesome. Well, thank you guys so much, and that concludes our panel.